Hello, everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. My name is Zach. I'll be introducing Rob here in just a few moments, but first and foremost, we have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Feel free to take a screenshot if you like. That's the main point to take away. It's always available on our website for you to read in detail at your leisure. Obviously, it's about the Fed meeting tomorrow, and now the market consolidates in anticipation of that meeting outcome. So interested to get right into the exciting topics for today. Without further ado, here's Rob.
Hey, Zach. Hey, everyone. Welcome to this week's Trade Finder Live. As Zach mentioned, it's all about the Fed tomorrow, and the market is consolidating, as you mentioned, Zach, moving into that. It's going to be a highly anticipated Fed meeting. Let's look at the chart real quick, and then we'll discuss that just a little bit further. You can see that we have really leveled off on the 10-day moving average. So if I spread the chart out just a bit, you can see that we had that run up. We had the vertical move, not vertical, but more than 45-degree move up to the upper trend line of this still condensing upward pennant pattern, consolidating pennant pattern. So far, everything is playing out. People keep getting asking on the U.S. market update, could this still be an ending diagonal? Absolutely nothing has changed to prevent that, other than when we relabeled from the 5 to the 3, which could have just put it off a bit. So we're having the 10-day moving average moving up, and then for going on, now we're getting on second week now of just basically going sideways through here. Now you can see right now we are trading below the 10-day moving average at this moment while we are live here on TradeFinder. But we're just kind of in the middle of this pattern, and I've extended the lines on the ascending pennant pattern. You can see how they are continuing to close together, so more consolidation, and that level of the 100% C-wave extension on the zigzag within the wave 3 is still right there at 615, and that seems to be where we are destined to go. Now let's talk a little bit about that Fed meeting that you mentioned, Zach. Lots of times we talk about how a Fed meeting is highly anticipated. Then we've had some times where it's like, all right, this is just a non-event. Everybody knows what the Fed's going to do. And then it seems like over the past 6 months or so, it's been more about what the Fed says than does, because we anticipated that they were going to start moving into a rate cutting cycle, which they did. Bit of a surprise on a 50 basis point rate cut out of the first one. And now we get to this meeting where it's back to a bit of a toss of a coin. The equities market does expect that we're going to get that 25 basis point rate cut. And if we do, then we probably continue up in this wave 3, the C wave extension. And that's where I think we are in the markets. We have really two clear scenarios, I believe. If the Fed does what the market expects, cuts the 25 basis points, then of course the market's going to want to know what Chairman Powell has to say. What's their plan? Are they going to continue to cut, or are they going to pause? And I think it's highly likely if they do cut the 25 basis points, which for me personally is not a done deal. It's likely, it's what's priced in, but it's not a certainty. And they could actually surprise the market and not cut and pause now. If they did, then I think we could start to see a little bit of a correction, perhaps the start of the wave 4 before then turning and heading back up into the end of the year. Or if they do exactly what's expected and say that, okay, we cut the 25 basis points, now we're going to be data dependent. In other words, they don't commit to a pause. I think that's fodder for the market just to continue this march higher. It might even be enough if the Fed cuts and then says they're going to pause, because there's a number of people that are saying they don't think they should cut. But I think those are the two scenarios. The Fed does exactly what the market expects. They don't do anything or say anything unusual in the commentary, and we stay status quo, and then perhaps that corrective move comes after the first of the year, which is not unusual. I've been explaining to our subscribers at ewotrader.com that oftentimes I've gone through this with y'all, that we had this period of time where we have a little bit of a melt up into the end of the year, and that's because a lot of the investment managers that have reached their benchmark aren't trading. And then if we continue up, and oftentimes the market does go up between Christmas and New Year's, the Santa Claus rally, and then we correct that. Everything that occurred in this period of lighter volume when some of them were out are like, okay, well, we want to capture that move, and things have a odd way of correcting back to where we were when we had the melt up, so that they can be involved with the next move. So we get a bit of a correction and then we move higher. So those are the two scenarios. I think Fed does what's expected, market creeps higher into the end of the year, or the Fed surprises the market without cutting rates, and perhaps that starts the wave for correction. Then we move higher following that. So I think it seems pretty clear cut between those two scenarios. But this pattern has just continued to play out exactly as we've been drawing it and talking about it for weeks and weeks. Let's get to the bond market real quick and talk about that with TLT, the 20-year. You can see a little bit of a bounce up in prices today, but we've been going down in price, which means up in yields. So a little bit of a bounce here with this movement to the upside in prices. So just a little bit of a break on yields today, but you look at where we were and we had gone a little vertical to the downside. So we had a little separation from the 10-day moving average. So just a little consolidation here, no major bounce up in prices. So the bond market still with this movement down in prices and up in yields just doesn't seem to be convinced that the Fed is going to go through with their cut, or they view that there is a potential, or at least is concerned about the potential for inflation coming back, the Fed pausing and stopping the rate cuts. And we have to wait and see when President-elect Trump gets into office about the tariffs. There's been some good mathematical data on the financial networks talking about inflation from tariffs and how much it adds to the CPI. It's not nothing, but if President Trump does enact some tariffs, but maybe not to the degree that he's been threatening, and a lot of people feel like he's just using that for leverage, then we could see a little bit of a tick back down as the market would not be so concerned about the importation of inflation at that point in time. But for now, they're not so sure. And you guys asked for it. I used to show it all the time. I switched to the TLT just because it was more of a in between the shorter and the longer end of the yield curve. But here it is. Here's the TNX. Now, remember, TNX is interest rates. TLT is prices. TNX is interest rates. So that's why they look the opposite. So we've had rates moving up on the TNX, and that coincides with everything that I was just saying with TLT. So just kind of show both of them as that's what people like to see, apparently, just going from your comments. Now, one thing that's interesting right now is where the VIX is. Because I've been talking about this down here around 12 and a half. So we came down, we tested that lower end. I drew this line here around 15 because you can see it acted as support for quite some time back here ever since basically we had Yen Monday. The 15 level acted as support. Well, then we broke that towards the end of November and moved back down towards that lower level at 12 and a half, which meant that 15 now acts as resistance. And so we bounced up against it here towards the very end of November, all the way down to that 12 and a half level. But look where we are now. We are right on that 15 level. And I've been mentioning that if the VIX were to break above 15, then we might have something going in more volatility. So you can see that the market is not 100% convinced that we're getting the rate cut. And I think a little bit of volatility is being priced in here just in case the Fed were to surprise the market a bit. So to summarize my thoughts on the Fed meeting we've had, where we were anticipating what's the Fed going to do? Are they going to cut or are they not going to cut? And then we've had meetings where it's like, all right, it doesn't really matter what they do. We know what they're going to do. It's more important about what they say after the meeting. This is a combination of both. I think we have both being anticipated in this meeting. Are they actually going to cut? And if they do, then what do they say? So two pieces, and I think that's just enough to put a little volatility into the markets in anticipation of that. And whatever the Fed does will determine where we go from here. So it's more about just positioning what can happen on either scenario. So if we move higher, then we likely complete this zigzag pattern. And if we don't, maybe we start that wave four and we look for a different type of a setup on the pattern. Looking at the other U.S. markets, the Dow continues, and it's going to be if the Dow finishes to the downside today, which this is pretty amazing to me with where we've been, all the commentary that you've heard about the economy, and everything's going to be great next year, and pro-growth administration, etc. And yet, if the Dow finishes to the downside today, which it looks like that's highly likely, then it will be 9 days in a row, which is the longest streak since the 70s that the Dow has been to the downside every single day. So I actually talked about this last week, pulling back. We were just in the middle of this trend channel. We don't have the same formation as far as the diagonal formation or the ascending pennant pattern where we're getting the consolidation at the upper end. This is just a plain old basic trend channel, as basic technical analysis as you can get. And look, there's that 4. That's interesting, is that we do have a wave 4 labeled on the Dow, which we do not have yet on the S&P. And I've surmised that if the Fed surprised the market and didn't cut, then perhaps the S&P follows the Dow, and we do pull back and create that wave 4. But just down, 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 down every day for 2 weeks now on the Dow. And now we're at the lower end of this trend line. We're also right at the 50-day moving average, which is that royal blue line. And look, we're just barely at that 23.6% level. So if Elliott was here, as I've commented a lot, he wouldn't be too caught up in the fact that this is indeed the wave 4. He labeled his algorithm to show a wave 4 when you hit that 23.6% level, because he believed a lot in these Fibonacci levels of support and resistance. But he would prefer to see more of a pullback for this to indeed be a clear-cut wave 4. But it has labeled, and looks like we're going to hang around here at the 50-day moving average. Maybe that's all the Dow needed to do, was just come back, test the 50-day moving average, and maybe we bounce from here. But we're going to find out a lot tomorrow afternoon. So I'm not sure we're going to get too much activity between now and then. I'm a little surprised that we gapped down on the DIA today. Didn't think that we'd do that. Then the question becomes, is this the blow off bottom? We were just talking in the crypto show. And by the way, if you haven't gone to look at that and you're interested in cryptos, please go to the Hub Financial channel over on YouTube and register, and you'll see what we talk about. We talk about all things crypto on the Hub channel. And we talked about, could we get a FOMO to the upside on Bitcoin? We've had the nice breakout to the upside, which I'll show you in a minute, but we haven't had the big spike. Is this the ending of the downward move on the Dow? In other words, we're going down, 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 down. Then everybody's like, oh, the Dow's going down. We got to get out. And then you get a gap down, and maybe that gives you a little bit of a break in the selling pressure. And then we get a little bit of a bounce from there. And I'll talk to you about how that could be the opposite play out on the Bitcoin side of things. Let's look at the Qs. And when we take a look at the chart of the Qs, a little bit of consolidation, doji at the moment, but still time between now and when the market closes. So that could change. Got a little bit overbought. Still amazed at the power of the movement of the Qs, even a little bit above the 45-degree angle, even as we've had rates ticking back to the upside. Really surprising to me. And this is where the disconnect comes in between the equities market and the bond market, where the bond market has been ticking up in rates, concerned about potential inflation, concerned about how much the Fed's going to cut. Are they behind? All that stuff that you've been hearing about. And yet the Qs have been managing to go up in the face of all that tick up in rates. And then today, we get actually a little bit of a tick down in rates, and then we get a pause in the Qs. And this trade has been pretty much a lockstep type of a movement between the bond market and the Qs, where whatever happens in the bond market, the opposite happens in the Qs. And talk about how correlations exist until they don't. So perhaps we're breaking away from that with the fact that the Qs have gone up while rates have gone up, and then we're consolidating on a day when rates actually tick down. So perhaps that correlation is ending, at least in the near term. But we did get a little bit above the 10-day moving average on yesterday's close. So little sideways movement, pretty normal and warranted on the Qs. The one market that has actually been performing exactly as you would think it should be, as I've said, the Dow, just from a point of uh, safety, defensive minded, being in the Dow, has, about to set a movement to the downside that we haven't seen in 50 years. And yet the IWM just marches down exactly as you would expect because of rates. So the IWM and the Dow have both been going down, but for completely different reasons, it would seem. I'm a believer, a lot of people are, that the small caps are susceptible to interest rates. And so the fact that rates have been ticking up, we've had this movement down in the IWM. Again, that just makes perfect sense. It's the one market that's doing what you would expect, at least on the equities side. And so here we are. We tapped the 50-day moving average on the low of the day. We're off of it a little bit, but we are below the 30-day moving average. And now we're watching to see, as we're starting to get a little close now to a potential bearish cross there between the 10-day and the 30-day moving average. And the 30-day moving average is this fuchsia colored line. The blue line is the 50-day. We bounced off that. We've talked about how the B wave in the zigzag pattern was right at the 61.8% level, which is, in my mind, the strongest of all fib levels. And we're back almost testing that level. We're very close. But maybe we hold here at the 50-day moving average and turn back up. And then we have a higher low here. And that could be a little bit of short-term momentum, at least for the IWM to turn and move back to the upside. But I think for that to occur, the IWM needs the Fed to do the rate cut and then not act too hawkish. Just say, we're going to pause. We're going to wait a little bit. We're going to see how the data comes in, which is what I expect them to say. I'm still not convinced we're going to get the rate cut. It is likely, though. I'm just not convinced. But if they cut the 25 basis points, I do feel like they're going to come in and say, all right, now we're going to see. We're going to become more data dependent than we've been. We're going to really take a hard look at the data as it comes in. But I think that's just going to be an excuse because really they want to wait and see what President-elect Trump's going to do. Is he going to enact these tariffs? Is that going to import inflation? Is that going to affect monetary policy? All these things are going to be answered in the month of January, but we're still in December, so we don't know that yet. So I think it'll be interesting to see if we can bounce off this 50-day moving average. Just one last quick note on the IWM. If we do break below where this B wave was, we break below this 61.8% level, it's highly likely we're coming back down to the 0 point, the starting point of this zigzag. So that would mean a break of this 225 level that acted as resistance in early fall or fall and early winter. So that's the thing to watch here on the IWM is this B wave that we're very close to, just not quite there yet. And note again, a wave 4 labeled in the IWM. So we have that in the Dow, and we have that in the IWM. We look at the Qs, and no wave 4 in the Qs, and no wave 4 yet in the S&P. So you know where the action's been to the upside. It's been in the S&P and the Qs, and breadth has been getting thinner and thinner and thinner. And that just goes to those handful of stocks that have been moving up, and they've been holding the indices in there, if you will, on the S&P and the Qs. Let's take a look at the metals. We'll do those first, and then we'll come back and do cryptos. And so far, kind of getting this one pretty spot on, feeling like the metals are just going to be in a wait-and-see mode. They're going to stay in a broad trading range. We had this real small triangle. We broke out. We came back to the point of breakout. So all those rules are done, and we're right back here where the moving averages are all converging. And I think we just stay in a bit of a trading range between both GLD and SLV as we begin to move into the next administration coming in to see what policies actually are going to be enacted. So it'll be time for talking to end and the actions to begin, and we'll see what they are. There was a note on the U.S. market update that I wanted to reference because I've been focused on this zigzag pattern that completed itself, the wave 4 correction, the fact that we've come right back down to not only where the B wave was in the zigzag, but the wave 4 has been right at the 61.8% fib level. We've got all kind of support right here where we are. But if we take the zigzag off so that you can see the chart a little more clear, you can see where we have actually the potential for not a badly formed head and shoulders pattern. And we're right at the neckline right now. So if we look at that, that's the left shoulder, that's the head, that's the right shoulder. And then this line of support is what's known as the neckline. If you're not familiar with how a head and shoulders pattern works, it's oftentimes a reversal pattern. So you form the left shoulder, the head, the right shoulder, and then when you break below the neckline, the movement to the downside, and this is the same to the upside if it's an inverse head and shoulders, but talking about this one, what normally happens is if we break this neckline and we have follow through, the movement to the downside coincides with the distance from the neckline to the top of the head. So you'd measure from roughly 28 to, let's just call it 31. We'll round it down. So a 3-point move, which would mean if we break below this neckline, you would expect SLV to come down to 25. And that happens to be exactly where the wave 2 was labeled. So we pretty much would disqualify this entire 5-wave pattern. And when you disqualify a pattern, normally it retraces the entire pattern. So that would play out really well. Now we still have to break this level at 28 with follow through. But if we do, then it ties in with all the rules of not only what happens when a neckline is broken on a head and shoulders pattern, but also when you have a failed Ellie wave pattern. So both of those could come into play with a potential movement on SLV down to 25. But I think the metals are going to have a little bit of a movement tomorrow based on what the Fed says or does, but I don't think there's going to be anything of significance until we do get into the new administration. But this head and shoulders pattern is formed well enough to at least note that, and that would certainly change the trading range type of scenario. Is it possible that we have a big breakdown in SLV from this head and shoulders pattern and gold stays in a trading range? They can discorrelate for a while. As we know, the metals can do that. They can, I call it discombobulation. They get out of whack where they normally move, at least in some sort of similar fashion, not exactly, but some sort of similar fashion. But then sometimes they diverge and they move different ways, and then eventually they come back and the patterns become similar again. So it wouldn't be that unusual to see differences between the two. But if we get a move down in silver, we could also get a move down in gold. If we did break that level, then you would see 235. I still think that stays in my trading range scenario because that's kind of around where the range is between 235 and let's just go up and bring this line up here to 255. So there's a little bit of congestion right through there, just above 250. The high of the wave 5, just above 255. So you could put a line anywhere through here between 252 and 255 as far as the trading range. So I think we could have a move down in gold, not give up the 235 level, and we stay in a trading range. And I just think there's enough concern about where things are. There's a lot of information on the financial networks this morning talking about things pulling back globally. A lot of speculation that's why the S&P has been performing well is we're seeing more weakness in other countries around the globe than we're seeing in the U.S. economy. And the U.S. economy is the place to invest right now. And that's been keeping the bid under the S&P. I think that makes sense because when you look at data around the globe, it's softening quite a bit in other countries. And there's a mess going on in Germany right now. We talked about the German market. I'll bring that chart up here in a moment. But let's get to the cryptos. We look at Bitcoin trading over 107,000 right now. And as I mentioned, we just recorded this week's crypto show for the Hub Financial channel and talking about where Bitcoin could go by the end of the year. We had this nice run up that was consolidated post-election to 100,000. So we hit the high here, consolidated there, formed this ascending triangle, broke out of it. I thought we'd go to 110, which doesn't seem that far away now. And then we'll wait. But the Bitcoin and the cryptos could be affected by what happens in the Fed meeting tomorrow. And we had some chatter about that as far as, do we get a blow off top? Do we get the FOMO top on Bitcoin where we get past the Fed meeting tomorrow and then the view that President Trump is in the strategic reserve going to buy a whole bunch of Bitcoin for the country? Other countries are doing it. You're seeing more companies leverage to buy Bitcoin, very similar to what MicroStrategy has been doing and Michael Saylor. So we could get, as we start to tick a little vertical out of this, maybe we get a big spike up, and then that's a short-term blow off top. It's hard to envision, and I know there's still people that are out saying, well, Bitcoin could come crashing down and it's in a nosebleed area and there's no way I'm chasing it now. And I'm not suggesting you should chase Bitcoin right now because we have just broken out of this triangle. So that would be a tough ask to go long now. But I think we may be in a buy the dip scenario as we get some corrective moves. But I don't think the corrective moves are going to be that significant. It's hard to imagine where the big negative scenario is unless President Trump just doesn't follow along with what he said. And he doesn't. But even if the U.S. doesn't buy as much Bitcoin as they've been talking about, other countries are. And there's data that shows they are and what they're buying, and they're consistently buying, and it's keeping a bid under the cryptos. So hard to imagine the scenario where there's a significant move down. But certainly there's always corrections. Impulses and corrections are what makes any market, which is why Elliott Wave works so well. Then if we look at Ethereum, we're hanging around up around that 4,000 level. You can see we hit it again yesterday. And so we're right there at the extension of that zigzag. We'll see if we can break above that 100% extension, but understanding that with a B wave at 38.2, the first level, the expectation was 61.8, which we did. And then you look to see, is this going to be an extended C wave, which means it moves to the next fib level. And that was 100%. And we've done that. So we've already had an extension of the C wave. So to go again would be a further extension. It's happened before, but not as often as we get the first extension. That happens quite a bit. So the zigzag completed itself at 61.8. Then it went to an extended level at 100%. It would be another extended step to go to 161.8. And so that's what I'm saying, that does happen, but a much smaller percentage of the time than moving from where the target price is to the next extension. So I hope that makes sense. But Ethereum been performing pretty well. If it can get above 4,000, then it could highly likely go up to that 45 level. But perhaps that's it for today, and we'll see what happens in the Fed meeting tomorrow for that. And then we look at a couple of the other coins that we've been adding in. Cardano is consolidating here. It's continuing its consolidation move here in this triangle pattern. And then XRP, which has been in a triangle, looks to be breaking out today and moving to the upside out of its triangle. Cardano's not done that yet. And there's some concern about what's going on behind the scenes business-wise with Cardano. So we'll see if that one manages to break out as well, or if it breaks to the downside, which is always a possibility, but a little bit of a bid with some other news under XRP. Now let's take a look at natural gas, which we've been trying to get some sort of a trade forever, as you know, and it just won't cooperate. We do have this line of higher lows, but we're back down testing it once again today. So we had this triangle. We broke to the downside. You know the rules. You come back, you test the point of the triangle. We've done that. Doesn't always happen immediately, but it's going to happen high percentage of the time. We did that. Now we're back down and we're breaking below. All the major moving averages have all converged at the same spot here, 10, 30, and 50 that I look at. We broke down. We tested this lower trend line on the low. We're back above. We're off the lows of the day on natural gas. But it just seems like even with the news that you're seeing on the storms up north, winter, etc., that there's just a lot of supply on natural gas. And even this time of the year, with cold weather coming in, it hasn't been enough to sustain a bid under natural gas. So perhaps we stay in a trading range there. In fact, I think if you're prudent to go long natural gas, you would want to see a break above 16. If you wanted to be very aggressive, you could put on a trade between 15 and 16. If we're able to get back up to 15 again, you can see we got there, but no follow through and went back down. So we could potentially see a move up here to 16, but that would be a very short-term aggressive trading move. And more prudent move, as I mentioned, is if you want to go long natural gas, let it get above 16. And if it doesn't, then just keep an eye on it and wait and see. Here we are with oil, USO, just when it looked like we were testing that upper trend line of this symmetrical triangle. We've come back down today. Once again, just like natural gas, all the major moving averages converging together here, right towards the midpoint of the triangle. And as I've mentioned in ad nauseum, numerous times, that it's likely we're going to break out. The triangle's pretty well formed, lots of consolidation. We're probably going to get a move, but can we get above 77.5? Can we get below, call it 66 on the downside? I don't know. I feel like that oil is going to go through a pretty big trading range as well, very similar to what's going on with the metals. Just staying in a trading range until we get more information. The prevailing wisdom is the administration that's coming in is very pro domestic production, and we could create more supply, which should push prices down. My viewpoint is that whatever extra production the U.S. Is able to manufacture, OPEC's just going to cut the same amount to try to hold the price in this range. It's elevated enough that they're making good money, but it's not so high that it is inhibiting driving patterns, travel pattern movements, etc. None of that has been affected yet. People are willing to pay what they're paying at the gas pump now, and I think that's okay for OPEC. Like, if we can just stay here, we're good. And the prices are high enough that it's enticing for domestic companies to actually explore and try to drill more. But again, I think that additional production will be hedged off by OPEC. And that's purely my speculation, nothing more than that. Obviously, I don't have any insight into what goes on in OPEC, but that's just trying to apply a little common sense here to where we are from a technical standpoint. Let's take a look at, I am going to show you EWG because I mentioned it, and there's a lot of stuff going on in Germany, calling for a new election, etc. And so we had this big move off of, which I didn't understand at all, other than we completed the rules of the zigzag. So we had a 38.2% B wave correction. We went to the 61.8% extension. Looked like we might go to the further extension. We didn't. We held at what was supposed to happen on the zigzag. When a zigzag ends, you retrace the C wave, which we did, meaning we went all the way back down to where that B was labeled, the start of the C wave. So we corrected all that. All that was done. And then we had this move up here, which looked like the start of a new impulse move. And then we're pulling back. Now the question becomes, what are we forming here? So we've ended this initial impulse, which that's the hardest part to figure out, the A wave of a zigzag. Remember, every 5-wave pattern within LE wave starts with a zigzag. Not every zigzag turns into a 5-wave pattern. But looking at that, the hardest wave to predict is not the wave 3. I've shown you how you can use zigzags within the wave 3, figure out where they're going in the strongest fall waves. The hardest wave is the A wave. When's that going to end? They're really, other than just looking at support and resistance, there's no real way to know. But after the A wave is formed and you start to get the first corrective move, then you can start looking at possibilities. So we're pulling down right now here in the German market, and If we take a look at the zigzag to see what the retracement has been, we're right around 30% right now, which would yield up to a 61.8% level. But with all the news that's coming out, which is positive, the one catalyst to move the German market higher is they're just a little bit ahead of us on rate cuts in the Eurozone. But other than that, it's hard to see where the scenario is. So you have to let this corrective move play itself out, and let's figure out what fib level it stops at. Does it come all the way down to the 50-day moving average? What would get around a 50% correction? That might be interesting at that point in time, especially if it turns and heads back up. Then you have a very qualified zigzag, and you can look to trade that. But you're still in wait and see mode on the German market. But with all the negative news that's coming out, I think you'd have to say it's performing slightly better than what you would expect to see. I'll show you China real quick, and then we'll move on to our case study considerations. We're right back down here into this triangle, so that little blip there. I don't think anything happens out of this market in China here until we see what Trump is really going to do with the tariffs. What tariffs is he going to put on China? How much are they going to be? I think this is just consolidating and waiting there. So there's several markets that are in wait and see mode for once we get into the new administration, and let's see exactly what policies are put in place. With the makeup of Congress, Trump's going to have very little resistance getting his policies through. And then he also has the power of the pen for executive orders. We're just going to have to wait and see. And I think a lot of these markets, including China specifically, are going to wait and see that. All right, taking a look at our previous case study considerations. As you know, we had big, nice winners on both Mira and Amazon. We have XRT. There's going to be some retail data coming up later this week, and perhaps that breaks it from this trading range. It's just been going dead sideways. On the positive side, you can say, okay, well, we had this gap up vertical move off a very strong 61.8% fib level. We're at the 100% extension, which is where we're supposed to go. And again, we're waiting to see, are we going to get a further extension in the C wave up to the next level, 161.8? But very important to point out that 100% is the expected level out of the zigzag. 61.8% B wave correction yields 100% extension. Do we go to this next level? That's what we'll wait and see. And you could argue that that's been a pretty good consolidation. When you go vertically up with gaps like that, there could be some backing and filling, more than just sideways movement. You could get some downward corrections. We didn't get any of that. We're just going sideways here. Maybe that acts as a base. This is almost, and this goes back, Zach, to another one of the old expressions of the launch pad effect. Some of you that have been with us for a while haven't heard it talk about that for a bit, but that's when you have a very sideways consolidation like this, and then boom, you get a blast off move like a rocket moving off the launch pad, as a nod to growing up on the Space Coast in Florida. So that could be happening. We could get a blast off move here. You would want to see that sooner rather than later, because the longer we hang around without a chance of a move up, then you have to start bringing in the possibility, okay, maybe we're done. Maybe the C wave did end at the 100%, and then we're going to come back down towards this B wave. That's a possibility too. But for now, no reason to be concerned about this, and we'll wait to see if we get that blast off move off that launch pad effect. And then last week, we did symbol H for Hyatt Hotels, and we had a movement to the upside yesterday, back down today. So kind of status quo from where we were last week. Looked like yesterday we were about to break above that fib extension level. So we've got, call it the 61.8% B wave correction there, and that could yield to the 100% extension up there, just under 170 would be the price to look for. And it looked like we were on our way there yesterday, but that resistance at the top of the A wave impulse held, and we're pulling back a little bit today. But I don't think you put too much weight in anything that's going on today with that Fed meeting on the horizon tomorrow. There's a lot of wait and see going on in the markets right now. And as we've talked about already, not just what the Fed does, but what do they say afterwards is going to be analyzed and dissected. Every word that comes out of Chairman Powell's mouth, they'll be talking about. So the case study consideration that we're going to do today is we're going to look at, for one thing, kind of going to give you a little bit of a bonus one, give you an insight into what our alert subscribers are going to see coming up here this afternoon, which is a movement to the upside in Apple. Apple has shown up on the AI scans, but what we're going to post, which I think is pretty interesting for the case study consideration, is a downward move in CVS. I think that you can see that we broke below where the AI target was to the downside, and we're continuing down. Now, we do have a potential bit of support here down around this 161.8% level as we move down in CVS, and we are getting a little bit oversold. So be aware of that. But I think that there is more potential movement to the downside on CVS based on the fact that there's that line that I've drawn. And as I start to condense the chart, look how long it's been since CVS has been down here. I really think there's a lot of problems there. And the likelihood is that we continue lower. The only concern is that we're a bit oversold already at the moment. So take that into account. But I feel like, look at that. We're into 2020 now. That's how far back we have to go to see CVS. So back into early COVID days, right at the beginning of it, to see a movement that far down in CVS. So I do think that there is some greater weakness here, and who knows where the bottom could be on CVS. And with the potential for a market correction, we would go ahead and look for that to move lower. We'll probably give this a little extra time in case there's a short-term bounce back to the upside. The problem is, where's the target? Where do you find the target price on this breakdown in CVS? How far down could it go? And boy, that's a difficult question to figure out where CVS could go. It could be anywhere. This is the exact opposite of that analogy that I use of a race car being out in front, being in the clean air, engine runs better, performance is better, no resistance in front of you, like the cars in the back of the pack do with hot air and rubber pellets from tires, all that kind of stuff the engines have to deal with. Same thing happens on the way down. If you break support, you could go lower and you could get into the Hewitt, Zach, when you're breaking to the downside, the Katie bar the door scenario, where I think that's in play with CVS. So the only question in my mind is, do we bounce a little bit first before heading lower, or do we just keep falling off the cliff here? But there's a lot of problems there. And the fact that we just went right through that AI target and lower today, I think is pretty telling as far as how far down we could go with CVS. So with that, Zach, we'll go ahead and take a few questions, and then we'll let you come back on and show the folks how to input an idea on the platform, which I think is one of the greatest features of this. All the technical analysis stuff is so cool, the live LA wave and all that, but the fact that we have the social media aspect, having all that in one place is, instead of having to go to your charts in one place and chat rooms on the other, you got everything right here. And I think it's a great help and an aid in trading and communicating with others. So, all right, I'll stop communicating, Zach, so we can get some questions.
Alrighty. Yeah, no, I couldn't agree more. Let's start out with a question here from Trade Simple, who would like to look at you.
Good old you, huh? Unity Software. And we're getting a little bit of a pullback So we had a wave 3 move to the upside, and this is the area to watch right through here, exactly where we are now. So if you want to be long this stock, it needs to hold right now. This is it. This is ground zero right here, the line in the sand, if you will. Pick your favorite analogy. But it needs to hold here because you can see it's breaking below the 10-day moving average, but it is sitting on support from the highs that occurred back in September and a little bit of consolidation and congestion through here at the end of November. We're sitting there right now. And if you want to be long, or if you are long, I wouldn't get out yet. But if it breaks below this level right here, I would exit. If you're looking for an entry, let's let it bounce back above the 10-day moving average first, and then you can look to go long. But if you are long and you are holding it, it's D-Day time right here. We need to hold this level. That's what's important.
Very well. Thanks, Rob. Excuse me. Next up, we're going to go over to a question from Gata, wondering if I need to exit BKNG before earnings.
EKNG.
BEK, as in Bravo.
BK. Sorry. We had Hyatt as one of our signals. It came from the AI that we utilized, which looks to go higher. It seems like, based on what we've heard from the cruise lines, et cetera, that people are traveling. There's always, you never know when it comes to earnings. That's the difficult thing. And we have portfolios designed around earnings reports on ones that are expected to really move, on those that feel like that there's too much of a price movement projected in. And it's always difficult. And the market, right, goes when the market is moving up and we're in a big rally mode where bad news is good news. In other words, there is no bad news. And then when the market starts to correct, you can go into a scenario where good news, where it seems like if the market is in a corrective mode, even a great earnings report is picked apart and the stock goes down. There's no real rhyme or reason, is there, to what happens around earnings, which is why you do analysis on et cetera, which is what we do in some of our portfolios at Evo Trader. So with that, you take a look at this movement right here, right around the 10-day moving average. And if it breaks above that, then it could be really off to the races. As far as the answer to your question on should I exit prior to earnings, it's a tough one. It just depends on whether or not the market is turning or not. I do think it's going to be a good earnings report. That's what I want to say. I think they're going to have a very good earnings report. That's not the issue, I don't think. The issue is, how is the market going to perceive it? How is the market going to receive it? Is the market going to say, oh, awesome, off to the races we go again? Or is a good earnings report going to be sold into, which could very well happen with the fact that we are in the sideways movement here and in this consolidation that's occurring within this. I don't know exactly what day the earnings report is. Was that in the question? Because the Fed meeting tomorrow, determining where the market wants to go, could also play into how the market perceives an earnings report like that. So I know I haven't given you a very good answer. I haven't answered the question. I can't give you individual investment advice anyway, but those are the things to consider as far as how the market views things. My personal opinion, I think it's going to be a good earnings report, not as convinced on how the market is going to receive that earnings report. But I tend to lean towards the AI, with Hyatt saying that all of the macros, et cetera, favor a movement to the upside. So if I had a big gain already, like if you entered back here, down in this area, right through here, and you caught this whole move, I might want to at least take some off the table moving into the earnings report. Depending on when you entered, how much exposure you have would play into the final decision for me. But the unknown is how the market's going to handle it. It's in a strong wave three. We do have the ADX breaking back below 40, which that's a concern. For me, that would probably, if I was in it, even though knowing that it could bounce higher, I think having that ADX break below 40 after being up around 60, which is extremely high, that's normally your exit signal when you see the ADX break below 40. So just following those rules, I would probably go ahead and take my profits. But, there's always that chance that it sprints back to the upside. But for me, that's the way I would view it.
Thanks, Rob. We will go over to a question here from Lisa now on NEO.
NIO, I assume?
That is correct.
Yeah, I just think anything China right now, we just have to wait and see. The FXI I showed, which is a China ETF, is in consolidation mode in that big huge triangle that it tried to break out of and move right back down into it. We're holding around here this level. We got a spike here in NEO at the same time we got that spike out of FXI and it came back down. I just don't think anything China related is going to make much of a move until we find out what Trump is going to do tariff wise, because you can see Alibaba had the same thing. And that's one place that I would look, especially this time of year, for a stock, but it had the same gap up and then has come right back down. So everything that had that bounce has come right back down to support. And I feel like we're just going to go through a wait and see phase for anything China related for a few weeks now. And then once we find out what Trump's plans to fully enact actually are, then we can make some decisions on anything China related. But for now, I think you just have to sit on your hands. Otherwise, you're just holding your nose and jumping in the deep end right now.
Alrighty, very well. Next up, we're going to go over to, excuse me, question here. Lost it on quantum stocks. That's what it was from Jeff on QBTS.
QBTS?
That's correct.
Well, it's becoming the new buzzwords, right? We're talking about quantum all over the place, just like we were AI. So now it's switched over to quantum is the new buzzword. So you say that and you automatically get a bid, just like when you said anything AI related, you got a bid. Same thing here. We had nice consolidation there at 5, and it held there and it broke above it. And just as a reminder on these price levels, the way it works regulatory wise is if you are investment management company, mutual fund, etc., that wants to put money into a particular stock, you have to be registered as aggressive growth to buy anything underneath $10 a share. And so you can do it at $5. So $5 becomes an area where you're off the pink sheets here, you're off the penny stock viewpoint. You get above 5. The aggressive growth companies that want to buy it can buy it, which clearly they have because we've had 2 vertical days movement to the upsides. Take a look at volume. You can see big volume there. So that's institutional buying that has occurred here. And then if it can break 10, then you get another wave of it as any investment company that's registered as growth or better as their investment objective can buy $10 stocks. So that would be the next level. But right now, we're so vertical. You know how I feel about this. You probably already knew what I was going to say before you even asked the question. This is too vertical, too fast for me, too far from the 10-day moving average. We're well off the highs of the day already, so we've pulled back to here. And that could be a good area of consolidation, which is what needs to happen after these vertical moves. So maybe we get a bit of consolidation. Ideally, it would be exactly what formed here, just under 5. So if we can do that again, just under 10, then maybe we can break the 10 level And then you could have something. Then you have a whole bunch more investment companies, a whole lot more money that can come in and buy this stock if it's one they're interested in. But if you caught this move, congratulations, awesome. If you're looking for an entry, I think I would wait. Let's let this play out a little bit, calm down, consolidate a little bit, and then you could step in. And if it could get above 10, it could go anywhere. So those are the steps. Those are the levels to keep an eye on. If you're already long, then could you could then move to down to 5 as potential support. But as long as it stays above 5, if you're long now, I would stay in it, knowing that you might get some backing and filling.
Very well. Thanks for the insight there, Rob. Let's go over the behemoth of NVIDIA for Will. Seems to have lost all its momentum.
Yeah, well, we knew the momentum was going to go away, right? When you get promoted like that, you move into the Dow, et cetera, then that always ends the momentum phase and people look to move elsewhere. Don't feel like there's anything negative in the story of NVIDIA. Nothing significantly or materially has changed other than the fact that that's kind of the kiss of death. We're pulling down into a wave 4. We're getting right around a 50% correction here. Would have been better if we could have held up here at 140 and used that to bounce from. We had a little bit of a descending triangle there, as you can see from the lower highs that occurred with that support at 140. We've broken below that. It wasn't a huge triangle, so we're already in the area where the breakout from the triangle has been satisfied. We're down here towards the point of the previous triangle that occurred back in October before this upward breakout. And so we're testing that now. I think we're in an area now where NVIDIA could find some footing. It's been moving down, the Dow's been moving down, et cetera. And just, this is just what happens when stocks get elevated like that. People look elsewhere for the momentum trades. And we'll see wave 4. Now, notice the algorithm has labeled it purple. So it's feeling like it's not green, which means that the algorithm is not sure the wave is complete. The algorithm is telling you we could very well end this wave 4 right in this area. Doesn't mean it can't move a little lower, but shouldn't move too much lower. And we're a little below the 10-day moving average. So if you wanted to look for an aggressive play here, I think you could look at NVIDIA now. It's had a pretty significant pullback from its highs. It doesn't mean it's never going to go up again just because the momentum phase is over. But this could be an area to look at and maybe dip your toes in the water if you had some discretionary income that you wanted to put in there for a continued move back to the upside. I think this would be an interesting place to maybe take a shot at NVIDIA.
Very well. Thanks, Rob. With just 1 minute left in the session and the holidays coming up, I figured we'd pass through 1 or 2 more questions, and then we'll just post the trade idea or case study consideration right after this session for everyone to be able to interact with there and allow more time for Q&A before the holidays. Does that work for you?
Sure. Sounds good. Yeah, just as you're mentioning that, let everybody know, obviously, next week will be Christmas Eve. The following week then will be New Year's Eve, so we will not be doing TradeFinder over the next couple of weeks. So yeah, let's do a couple extra questions on this one, and then we'll see everybody again after the first of the year.
Yes, indeed. Very much looking forward to that. So let's look at the chart of MSOS for JN.
Cannabis ETF, and that they've been, when they were rocketing higher, they were crazy to watch, and then they've kind of gone through consolidation. I'm not too familiar with what this ETF has in it, what stocks are located within this one, but it is getting awfully oversold at this point in time. Let's take a look at the CCI here. If we're starting to get to an extreme point low, Well, you're getting divergence. We did have an extreme point low back here in early November, but note that as we came down again, we made a higher low and we've started back up. So even as the stock continues to drift lower, you can see down in the wave 3, right underneath that 10-day moving average, we're diverging. So as we creep lower, it's getting weaker and weaker and weaker on the way down, which means you're getting close to at least a tradable bounce. It doesn't mean that, we're done going to the downside or anything. It could just be a wave 4 bounce back to the upside, but that's pretty strong divergence. So you can see what I mean. You've got the higher low there on the CCI, and then the price has got a lower low. That's divergence. So notice those two lines are moving in opposite angles. So again, if you had some really speculative money, and if you're looking at this stock that probably is speculative type money, I think you could take a shot here. If you wanted just a little bit more comfort, let it get back above the 10-day moving average first. But based on this divergence in the CCI, it seems like we're going to get at least some sort of a bounce here in the not too distant future, because this is really running out of steam to the downside. It could go a little lower, but it's getting weaker and weaker and weaker as it goes. And at some point, we'll get a little bit of a bounce. I'm not saying we're going to come all the way back up and fill this gap yet or anything along those lines, but we could give a little bit of a bounce, at least back up to 5, maybe back up into this area here, which is where it found a little bit of support on the initial drop. I assume that was an earnings related thing. I'm not sure what was going on there. But I think that one could be interesting. If it drifted a little bit lower, maybe you add to it. But you're only looking for a tradable bounce here, though. I want to be clear on that. It doesn't mean that the downside's over. We could just get the wave 4 bounce before moving lower. But we're definitely running out of steam on the downside here on this one. All right, another one.
Alrighty, we'll go to Zoom, ZM for Clive.
Haven't looked at Zoom for a while. Gosh, I remember when that was up there with all the craziness back in COVID days, where it was just going nuts.
Yes,
you can
indeed.
see we've consolidated pretty well through here. Where on the CCI, which is the shorter term indicator, we're right at the 0 point. So we're back to literally the starting ground, if you will, on the CCI. So it's not telling us anything as far as direction here, other than it could turn and go either way. The wave 4 still green, so the algorithm is not convinced. And by the way, this is the algorithm as written by Ralph Nelson Elliott that this Hub software uses. If you're joining us and this is your first time, go to hub.com, HUBB.com. You can get a copy of the software for free. You get the Elliott Wave for free, intraday, etc. Fantastic piece of software. Amazing. I'm a big Elliott Wave fan, as you all know, and I'm going to use whatever I think is the best Elliott Wave software. And I'm convinced, based on my own trials, that this is it. So the algorithm is saying, not me, because sometimes people say, I don't know if I agree with where you labeled these things. Well, I don't put these labels on personally. The algorithm does it based on all the pages of code that Ralph Nelson Elliott wrote. So all I do is try to interpret it as best I can, but I'm not the one that actually labels them. So looking right here at this wave 4, right around the 30% level, we're bouncing, touching our head against the 10-day moving average here. I think if we start to see some weakening, which we are globally already, if we start to see some further weakening in the U.S. economy, we could start getting back to some of the same types of things that we saw occur back in the days of the lockdown, where there was more people staying at home. Maybe we start to see more Zoom meetings, less travel, et cetera, all those kind of things. But I would want to see it for me to go long back above this 10-day moving average right here and back above 85. If it can manage to do that, then that wave 4 may turn purple. It may be finished, or we could come down here to the 50-day moving average first. That's a possibility as well, especially since the algorithm's not sure we're done moving down. We are back hitting our head against the 10-day moving average on the high, but I would want even more than that. I would want even a move above the 10-day moving average and above this resistance area at 85. And then perhaps we're off and running on the wave 5. And if we can get high enough, we start to get into that area of 100 and the whole tractor beam effect starts to take hold. But we're not close enough yet. We got to get above 90 before that starts happening. So, to go long this one, I would just be watching and make sure it gets above 85 first, because there is that risk that we're coming down to the 50-day moving average first to test it out. So that's what I would view there. All right. So we will, as Zach said, we'll get that CVS position posted in the TradeFinder social media aspect on there as our case study for the week. And as always, thanks everybody for your attention and your time. We value it very much. And especially this time of year, we start looking at spending time with family, friends, and loved ones. And I hope all of you that are watching get an opportunity to do that during this holiday season. Hope you have a wonderful holiday season. We'll be doing the U.S. market update, so we'll still have that. But we'll see you again after the first of the year for the next TradeFinder Live. Take care, everybody.